welcome everyone to this webinar. Normally we do webinars on Friday, but this is a special product webinar that we have kept in the midweek because this Friday, we are not doing any webinar. So, to begin with, I will just give you a quick context to this webinar. We have been always talking about equities, and equities is one of the most, I would say, favored and loved asset classes. But in the context of asset allocation, debt also is equally important. And today, in the current context of present times where valuations on equities are kind of high, at the same time we know there are a lot of opportunities which are there because interest rates are high on the debt side, and it is a space which needs to be understood kind of and deep dived through the lens of alternative investments. We have fair understanding of the private debt space through the lens of mutual funds, but mutual funds of late have seen increase in taxation, and for an economy like India, there are a lot of opportunities which are there in the performing private credit. And today's webinar is all about that. And we'll understand that straight from Mr. Mr. Shekhar Daga, who is, one of the speakers today. And, he heads private credit space at ICICI Prudential AMC. ICICI Prudential AMC is well known for managing debt space very well across all the mutual funds. We have seen 2018, 19, 20 era where a lot of debt mutual funds across AMCs had seen the fall because of the credit crisis, but ICICI AMC was one of the AMCs which actually came out really well. And the ICICI AMC has been kind of doing fairly good work in the space of alternatives also. In the private credit space, they have had one fund already, and this is the second fund they have recently launched. This particular webinar is not to talk about a product per se, but to understand this space of performing private credit. The performing private credit space is like the space where lending is done at a rate of say 12 to 14%. So 12 to 14% gross lending done, net of expenses in the hands of investors, say net of taxes and expenses comes to around say 8%. So this also is something which is very decent return given that it is a fixed income space. And how this adds value in the overall portfolio of investors, how is this space seen by HNIs, ultra HNIs, and what is the potential of this space, how are risks evaluated in this space. All this is covered in the presentation that Shekhar has prepared. Shekhar brings with him 2 decades of pertinent experience of managing structured finance, managing distressed assets, and he is heading private credit at ICICI Prudential AMC, as I mentioned. Welcome, Shekhar, to this webinar, and over to you, to kind of run through the first part in form of presentation, and then we'll do Q&A.
Thank you, Kamal. Thanks a lot for having me, and very good afternoon to everybody on the call. It's greatly heartening that people are there to understand on the private credit space. With public markets booming, it's pretty interesting that credit is also picking up. So what I will do, Pramal, is that I'll try to take a few pages on my presentation, set a preamble to the entire performing credit space, because credit itself is a very wide, actually. It is not like one specific segment of credit, because again in credit you have various return profiles, risk profiles. So let me take you through a few of the pages, and then we can get into the specifics of questions. Let me start like alternatives per se, actually, just as an asset class which you mentioned. It is a very growing business in West, actually. Traditionally, when we had looked for a portfolio allocation in any individuals or a corporation or family offices portfolio, we would see that there would be a combination of equity and debt. And it can be between 50-50, 60-40, and anybody can pick and choose a number based on the investor risk appetite and the age profile, actually. But what's happening globally is that the new allocation seems to be like equity has reduced a bit, fixed income have reduced a bit, and alternatives have taken a big space in the investor's portfolio. And one of the reason which is happening is that because large investors who are managing large pools of capital are looking for asset categories which can give them slightly different return profiles with less volatility as compared to the traditional asset classes. Now, alternative itself can be a wide range of option. It can start with private equity, it can start with a venture capital, it can start with a venture debt, and also we have the credit as a platform. But definitely what we are seeing is that investors with larger portfolios are looking alternatives as an option, and that's one of the reason we are seeing a big growth in the PMS and the AIF segments in India, where effectively people are coming to these platforms directly. Now, specifically, we see from a global perspective, private credit, which seems to be a new word, but it doesn't have a meaning per se. Historically, in India, it was done by the NBFCs and mutual funds. Now, effectively, there are local funds like us who are catering to this need. But the global fundraise in this asset profile has been increasing year on year. And it all started from a GFC crisis where effectively the traditional banks in the West stopped dealing with certain kind of transactions or risk profiles, which effectively moved to the asset managers who have been raising this private credit pool of capital, and it has now raising in excess of $200 billion of annual fundraise, which is happening year on year actually in this asset class. And we believe this asset class is going to increase multifold going forward because the traditional banks or the traditional capital providers, whether globally or in India, have vacating this space in a big way actually. And this pool of capital needs to be provided from some other sources, be it mutual funds, be it NBFCs, or be it fund like us, because definitely you can't run the business without this capital, because banks can provide a certain capital, but there are restrictions on what kind of capital they can provide, what can you use with that money actually. So I think in terms of a demand supply in private credit, it has been in press in India for long, actually over the last few months. You may be hearing a lot of private credit funds in the market. But the reason this is coming is that in India, over last 5 years, we have seen substantial dislocation in the credit markets. We have seen like a lot of entities in financial services going through turmoils, and which effectively has constrained the supply. There have been challenges with the banks also, and the flavor if effectively is going retail. So think of banks and NBFCs, they have pivoted their business more toward the retail business. Effectively, that's what is perceived better in the eyes of their investors. And that's one of the reasons they have vacated a big space of providing capital to corporates in a big way. Similarly, mutual funds also were a large capital providers in the asset category as well. But like post 2020, multiple events have happened, and the regulatory guidelines around these institutions have also got tightened. And as a philosophy, it was decided like most of the asset managers, like this kind of a credit should be done differently, and it should not be done in mutual fund. One of the big point I would like to highlight out here is that like a lot of these entities do used to lend long, like you will make an investment for 3 to 4 years, whereas your liability profile would be very short tenor. Like in a mutual fund, you can invest today and withdraw tomorrow, whereas a manager, if we invest, our investment would be 3 to 4 years. So inherently, you're creating a asset liability mismatch. Whereas when you invest through a fund platform in AIF, these are generally close-ended funds actually. So the supply side has shrunk. Our demand for this capital continues to be very high because India is growing. Promoters are needing capital. There can be transactions which cannot be financed by banks because of the end-use restrictions. So effectively, what we are seeing is that the demand for this pool of money is getting bigger and bigger actually. Now, effectively, private credit per se is very large. You need to silo and segregate it in different buckets. Like think of equity. When you think of equity, you have a large cap equity, you have a mid cap equity, and you have a small cap equity. The risk profile and the companies in each of the buckets are very different. If you want like to invest in tier one names, you will do a large cap equity mutual fund. If you want to take high risk, high return, you will do something like a small cap fund actually. So effectively in credit also, you need to think in the same way actually. There is a kind of a large cap, mid cap, and small cap in our world as well. And when we speak specifically the mutual fund, you think of it the best in class in terms of safety and everything, because the investment criteria in mutual fund is much more tighter. Then there is asset class of performing credit on which we are going to have a discussion today. That's something which is exactly in the middle actually. And there is an extreme other end where you start investing in turnaround companies, distressed companies, or a venture debt, and that's a very different asset profile. So again, as a credit as a canvas is very wide, the return expectation in different pools are different. So when investors are looking to invest in credit, private credit opportunities, they also need to think through what kind of risk they would like to take, what kind of return they should expect, and what are the risks in that actually. So Kamal, that's a short brief. I thought I should set the agenda out here, and I think I will be happy to address the questions going forward and explain the people around like how the entire market works actually.
Sure, Shekhar. So I think your presentation is quite crisp and I would say straightforward. Now, the foremost question, if I put myself in investor's shoes, comes to my mind is that why should I invest, in this particular asset class where you mentioned 12 to 14% is the performing credit, and net in the hands of investors, net of taxes and expenses, the number will be around say 8%. If this calculation is correct, then what is the logic of investing in this asset class in the overall context of asset allocation?
Okay. So think of a people who have debt allocation in their portfolio, how they would think of the allocation out there. Like in equity, you do large cap, mid cap, and small cap. Similarly, in debt, you will have a allocation to super liquid, then time horizon wise 1 year, 2 year money, and then long term money. The shorter the maturity, the returns are lower actually. You can always keep your money in fixed deposit at 8% or 7%. Post tax, that would be coming down to 5% actually. Similarly, if you put money in a mutual fund in a credit risk, which is the highest risk fund actually, you will get a post tax return of about 5.5%, 6% actually. Whereas this asset class gives you a slightly 2 to 50, 100 basis higher return. And if actually you are coming from a corporate vehicle, you are in somewhere in a 10% kind of a return expectation post taxes. So again, this product, what we perceive is a kind of a allocation within your debt portfolio. We are not saying that this should be the only debt investment, because this comes with slightly higher element of risk actually. So depending on your liquidity needs, risk profile, you can diversify your debt portfolio into broadly the segments of liquid money, maybe bank FD, and some portion in these kind of products. Definitely there are funds which are taking a different risk profile in credit, and they can provide you higher returns as well. So investor can look as a broad-based approach in this. Our recommendation generally is that alternates in debt in your entire debt profile. If you are presuming you have 100 rupees in debt, you should put approximately 20 rupees in these kind of funds actually.
Sure. Subsequent question that comes to my mind is that, obviously, as you said, there is an element of high risk in this fund. It's a private credit fund. What are the risks that you're talking about, and what are the processes that ICICI AMC follows to contain those risks?
Okay. So before getting there, I'd like to just may explain the transactions, what we do, Kamal, I think, before we come to the risk actually, because people should appreciate what exactly in private credit, because people's intuitive question is that banks are lending money at 8%, 9%. Why will somebody pay a 12 to 14 or maybe 15% return actually? Now, when you think of borrowing money from a bank, assuming everybody would have a home loan out here, and you have to pay a monthly interest, a monthly principal repayment, it is a very kind of a simple product with a set rules actually. You will get so much LTV, you have to pay the loan every month in a sequence actually. So effectively, even a corporate, if it borrows money from a bank, it has to pay a monthly interest. It has to pay a required asset cover. It has to do certain repayment in amortizing way actually. And over and above, when you borrow money from bank, you can use that money only for capital expenditure and working capital. So that's the biggest thing when we pitch for this product actually as a performing credit. We say that we will like to do transactions which banks will like to do but cannot do because it is restricted in the regulatory parlance to invest in those kind of end users actually. So a company cannot borrow from a bank today and invest in a downstream project in equity. It can only invest in capital expenditure and working capital. If at a promoter level, he has a private equity investor, or he has to do a family settlement, he has to give a pool of money to his partner or a private equity investor. It can be a AAA company underlying, but this transaction cannot be financed by banks in India. And that's the reason there is a kind of a premium which we can get. Definitely, it's on a riskier side. You are staying away from the cash flows in some portions. So you get slightly higher return on these products actually. So there are a lot of transactions which banks will fit in the bank parameter of credit actually, but not in terms of end use actually. So in private credit, we are much more flexible actually. Our solutions are much more bespoke to the requirements of the client actually. Assuming somebody has borrowed money and he has an annual stream of rentals or cash flow coming in form of dividend, you can't expect that borrower to make a monthly repayments actually of interest, because he's expecting his cash flow coming on an annual basis. So in an AIF format, when we invest in these products as a debenture, we can always customize the repayment schedule, the interest payment as per the cash flow of the borrower. We are not compelled by any regulation right now that I need to charge monthly interest. There is no compulsion for us actually. We can create a bespoke solution based on the cash flow requirements and the collateral comfort what we have with the borrower actually. So effectively, what we are effectively simply saying is that banks should be doing this trade, but there are nuisances around the cash flows, end uses, which something banks can't address. And that's where we come in play from a private credit perspective. There are a lot of times you will see that there are cash flow mismatches. The company has set up a plant, the plant is going through initial teething problems, but the bank loan has started repaying, becoming due. Now you cannot go and ask bank, please give me an extension because my plant is not operating at full capacity. So your earnings are not kicked in, but your repayments have started. Now, effectively, if you don't pay the bank, you will be classified as an NPA. It is nothing wrong with the company. The business is just taking some time to stabilize. So this pool of capital can again come in there and provide that liquidity support to the company so that he can again streamline this end cash flow in line with his business needs actually. So this is where effectively what we are seeing, it's a bespoke, flexible capital which can be provided. Definitely, it will come with its own kind of issues because the risk is definitely higher. So if you can just put the presentation on, maybe there is one page which I would like to show to the audience out here, which will just clarify the people much easier on that. So this is what I was talking about, customized capital. And if you can just stay with this page before we move into the process, if you look at the spectrum of the credit in the country, you have a credit where you can invest in a 6% paper and you can invest at a 25% paper actually. The spectrum is very wide and everything is credit. But as you go right, the risk increases, return also increases actually. So as an investor, you need to decide what risk you are comfortable with and what returns are commensurate to justify that risk what you're taking actually. If you are extremely risk averse, you should be playing with the bank FD and the mutual fund side of the business where you can give money to these platforms who will invest with a high grade bonds, working capital finance, or invest in a project finance or REIT actually, which are very high grade actually. But if you want to play the private credit side of the business, now you again have a spectrum of like fund like us, which is more performing credit. There can be high real estate. There can be special situation fund. There can be venture debt actually. So again, this spectrum is also very wide. You need to select what you are comfortable with actually. As ICICI Prudential, when we thought about this product, we are focusing more in the mid-market, exactly focusing in the middle rather than taking on the extreme right of higher risk return actually. So we've focused on a 12 to 16 bucket where effectively we are targeting a return of 13 to 14% actually. And that's the sweet spot we think is working for us actually. But different managers may have a different thought process and they can choose different products and which can be in the 18 to 20 or a 16 to 20 bucket actually. So again, from an investor perspective, when they see these private credit funds, they should think what risk they want to undertake and what return they are paying for that actually. Now, this is the most critical thing, that how do we think of getting these companies actually, and which is very important for any credit decision, like what are the things you want to do and what are the things you don't want to do actually. Like when you invest in equity, you want to invest company with established track record, you want to see past performance. So you have a set parameter that you need to see. So what is the debt equity? What is the profitability margin? So my personal belief is that the way you are evaluating an equity, you should evaluate the credit first of that company. Because if the company is surviving the credit, the equity will create value. Because there is no way your equity will create value if the debt is no value actually. So there are a lot of companies where we may not be comfortable with the debt. It should be sure that you should not be comfortable with equity also in those companies actually. So you need to have a parameter what is comfortable to you. Some people will say that they don't want to invest in long gestation projects like a greenfield. Typically, a credit fund is a 3-4 year fund actually. So when we do our deal origination and primary credit evaluation, we think of certain parameters like what is the kind of capital, how has the promoter behaved in the past. Like it is exactly like the way you think of equity. If the promoter has a checkered history with dealing with his shareholders or stakeholders in the past, or he has defaulted to the banks, there is no way somebody should look at a credit in that. In a performing credit space, definitely a special situation can look from a different lens per se. There can be instances where the business is very asset light actually. There are no assets. So in a credit business, if there are no assets, tomorrow something goes wrong, you don't have any asset to recover and recover your money actually. So generally when we look at performing credit, it is like how a bank looks at credit. Bank will look at what is the collateral they are getting, what is the security cover, and what is the tenor of the loan actually. So those are the simple parameters in performing credit also people will look at it. So that's a very important thing. And the other piece, when you look at the performing credit space generally, you will like to see how your money is going to come back. It is not like equity, you buy in the market and you can exit in the market. In credit, there is no stop loss, Kamal. So that's a big thing I want to tell investors. There is no stop loss. Tomorrow, if any decision goes wrong, you can't exit this instrument by pressing a button actually. So effectively, you need to be doing much more diligence before you get into the business actually and understand it. So you need to focus how is the cash flow of the company, exactly the way like an equity guy will do it, and what is the collateral you are getting, and how are you ensuring that collateral is safeguarded for your benefit actually. So there is no difference how you evaluate in equity and credit actually. In fact, credit you need to do a lot of actions before getting in, because in equity you can take a chance and do work as you go on, because you always know you can exit if you don't like the transaction later, company later. In credit, there is no second or chance actually. So once you are in the company, you are in the company, you have to work, pray, and ensure the company does well to get your money back. So that's the first step is very important when any credit manager or any fund manager is looking at it. What is this company? What is this sector? How are the cash flows? What is my collateral? And you need to think the most important thing is that how is your money going to come back? Because in equity, you can sell in the market. Here you can't do. Your money has to come back to you. So your principal has to come and the return on the principal has to come. So both the things need to come. So this is something which you need to be very cautious. And this is the first point which you check out. Once this is checked out, every institution will have a kind of a concept of a maker and checker, where effectively it is not that one person decides it. There would be a process through which there are independent checks and balances which would be built in, so that there is another set of eyes validating the entire transaction. And definitely there is a very detailed due diligence. Again, very much like how you understand equity, you have to do a very detailed financial diligence. You may have to visit sites. You need to get industry feedback and also the legal documentation. And also then thereafter, how do you take the final approval? Because it takes a process. This transaction takes 2 to 3 months. We can't do a transaction in 15 days or overnight actually. We have to create this transaction, do the work of diligence. So any deal in any spectrum of credit will take 2-3 months to create it actually. And the most important thing in our business is that once you have invested, you need to track these companies regularly. Like as an equity investor, you track this company on a quarterly result basis. We also track these companies on a very regular basis, rather monthly basis. What is the MIS? How is the company tracking? So these are the system processes you need to have if you are looking at credit, or any manager is looking at credit actually. And it is one of the most important thing, because in credit, there is no so much margin of safety actually. You can lose your money actually. So you need to be doing a lot more work before you invest actually, because after that you can try to do course correct, but if you have committed a big mistake, you still can go wrong. But one of the big things being said this, the way the corporate India today is looking, Kamal, is that we are seeing one of the most healthiest corporate India. The way market is perceiving India is that the companies are much more healthier. They have much more robust cash flows. And this is because we have seen that two big changes have happened in last 5-6 years in India. One is the bankruptcy regulations in the country, and subsequently we have seen the two COVID waves. What it has done is that the weaker set of corporates have weeded out actually, because there a lot of companies have got referred to NCLT, and the two COVID waves effectively have taken out all the weaker players in the market, and that's the reason the corporate India, what we are seeing today, is very healthy actually. I'm not saying that this trend can continue, but for a near-term future or medium-term future, we believe this trend will continue unless the capital allocation decisions of corporates and the promoters go wrong in a big way actually. But the financial discipline has come in a very big way. Reason being, people have realized that if they are not able to honor their debt commitments, they may lose their company. It was not the case earlier because we have seen a lot of large promoters losing their company. So from a credit perspective, you see the lenders has got lot more angle and handle on the promoter, that if they are misbehaving in any way, we can take the company back from him. Definitely, we are not in the business that we should do recovery. It will be a scenario where it would be more a doomsday scenario or something going bad. We don't want to wait for that day, but God forbid something comes, we have enough efforts or enough regulations with us which will help us doing that. So that's where I think I'll try to say the entire process framework works very well. You need to check this checklist very well. So the way you have an investment checklist in equity, you need to have a similar checklist in debt as well.
Sure, I think Shekhar, you answered quite insightfully. Before risks, we need to be aware of the overall context, and the opportunity here is quite, I would say, real, as you mentioned that the kind of lending which banks cannot do, and hence there is an opportunity for private credit funds. Now, in this particular space, from investors' point of view, there are two schools of thought that investors would have on their mind who are maybe attending this webinar. That on one side there are opportunities like private credit, where risk is more kind of taken care of and return could be lesser. And maybe such funds like yours is a favorable option, because we are talking about fixed income, and in fixed income the foremost, I would say, priority has to be containing risk and not maybe making returns.
Yeah.
But on the other side, the other school of thought, which investors are always lured towards, is that because in such funds taxation is high, and at the same time there will be some fixed costs, some performance fee, right? So ultimately, the kind of risk that one will take in even such fund, because there will be some theoretical risk that they are going to take in this fund, then why not maybe take a little more risk and invest in something like real estate lending fund or a distressed asset fund, where you can at least make returns somewhere closer to maybe index fund of an equity, right? So how to select between, I would say, performing credit and distressed credit? Maybe you can start by first addressing the actual theoretical difference between both, and then how to select between these two.
Sure, Shaman. So a very interesting question actually, and definitely every investor should quiz themselves what kind of returns they want to choose. So I'll just again go back on the same example. What kind of risk you want to take? So if you are extremely risk averse, you can go for a bank FD. These are not product for you. If you want to take slightly more moderate risk, performing credit will come. If you want to play a very high risk game, you can go to the distressed fund actually. Again, it's an asset allocation in the debt side, how you want to play it actually. You can do one third, one third. Again, it's the same large cap, small cap, mid cap theory, which you have to play it and play in your mind. Do as an equity investor, you play everything in small cap, you don't do it. You play a very real portfolio in a Nifty 50 or a BSE 30, then you will play the next level, and then you will play a micro cap or a small cap portfolio. Similarly, in the debt, you have to have the same mindset. If you want to play the full canvas, you start what are the three segments of the credit you want to play, because each segment comes with a different risk return actually. It doesn't mean that 20, because in credit is most important thing in India, we believe, like if I have given money at an loan, the money should come with principal and return together. We don't perceive that if it's a 25% return, you can lose money actually. Because if everybody is giving a 25% return guaranteed in debt, I'm assuming nobody will invest in equity, and people will come lot more allocation in debt, equity also, debt also. So unfortunately, it imbibed in our mind actually when we started, because when we invest in bank FD, we know money will come, redeem along with the interest actually. Same thing when you invest in a mutual fund, you know it will come along with returns and everything. But as you take higher and higher risk, there is always an element of capital loss you can have actually. So you need to bear that in mind. I'm not saying that there would be a capital loss, but intuitively higher risk will have a higher return. So you can also have some accidents possibly. Can the accident happen in AAA? Yes, it can happen. Can it happen in performing credit? Yes, it can happen in performing credit also. But effectively in the value chain, the risk is on a higher side in a distressed fund. We will have a lesser risk, and the mutual fund will have much lesser risk actually. It can always happen that the distressed fund would have given a better return than us, but that's an outcome which somebody has to wait and watch actually. And the other piece which you have to think from a perspective of an investor, what kind of returns he's targeting in his mind actually. Because not every fund is going to give you a return what he's expecting or risk reward. There can be a cycles of ups and downs. Like today we are looking at a 14% return in our fund right now as we speak right now, and net of expenses we are at 12% to the investors, and thereafter the investor tax bracket. Now, what are the options from investors? Because you rightly said, like, he will think of a mutual fund or he will think of a direct NCD or a bank FD. Now, you should compare your return on a post-tax basis. Today, at inflation at 6%, post-tax, you're not covering your inflation if you're putting money in bank FD, actually. So you need to look for products where effectively you can take slightly more risk. With a calculated risk, you can get a higher return. So you can play that game. And you can always look at a distress also as an opportunity where you can allocate some more capital to juice it up. So from an investor perspective, he can allocate his capital. And this is again, when we talk about investors in alternates, people should have an investable corpus of in excess of 10, 15 crores, because I will not recommend these products to somebody who has a 5 crore investment portfolio, because it is a high risk, high return program. So may not be suitable for them. You can take that equity call, but this is a product where large family offices, larger HNIs, who are focusing on larger capital allocation, because they will not put all their money in equity. They will do a debt allocation. And in your debt allocation, alternates will come in a reasonable size where you can take some calls of investing in a performing credit or maybe a distressed fund, or in some cases, maybe a venture debt also. And you should compare all your returns on post-tax basis. So mutual fund post-tax would be 5, we would be 8, a distress would be at 11. So that's where the delta will come in play. And as your risk and return appetite, you will think which is the right strategy for me, or what is my risk appetite and what risk I want to take.
Sure. I would put it, like this, that if investors are looking for actually returns, they should go for equity as an asset class. And obviously for fixed income as an asset class, one should be focused on risk. And hence one should compare performing credit with something like AAA focused mutual fund, and hence see the alpha. Not compare this with the distressed asset fund.
Exactly.
And 3% incremental return. That's the way to kind of look at it. And
Exactly.
hence this is a logical fit, in my opinion, in terms of the product offering. But the thing is that yes, investors are kind of driven by at times greed and fear, and that leads to confusion and maybe I would say relatively less informed investment decisions. So hence this question was important to be addressed by fund manager himself, and that is the reason I had asked this question.
No worries, happy to address it.
So now as you were trying to compare the process with equity as I would say investment. So let me also understand from you, like in equities, there are certain not to do lists. Many fund managers say that we will not invest in PSUs, we will not invest, in loss-making businesses, we will not invest in maybe recently listed IPOs, right? So likewise, what is such not to do list, or maybe a targeted list, if you as a fund manager want to cover for your fund or a private credit in general?
Sure. So Kamal, if you don't mind, you can show the presentation. I have a very good page on this, so which would be very clear from a picture perspective. Can you see this page? So this is one page where, as ICICI Prove, we have put our checklist out here. What are the things we don't do and what are the things we like to focus on? Let's think of what are the things we don't do actually. So in a performing credit fund, your life cycle is a 3-4 year fund actually. You can't take a greenfield risk actually, because greenfield projects take time for paying out cash flows. You need a 7-10 year fund actually. So Generally, a performing credit fund will not take a greenfield risk actually, because we don't know, there can be delays in the project, so the cash flows will not be there. Secondly, like the distress leverage turnaround, this is not like the cup of tea actually. We should not be doing it, because again, different risk profile. You can't put this in a performing credit. There can be a turnaround. We are not here to underwrite a turnaround, like how many turnarounds are successful. So we won't want to focus on turnaround actually. And when you look at credit, you want to have a collateral. You want to see real business, real assets. Because if something goes wrong, you should be able to put a hand on it. Okay, I can sell this and recover my money actually. But it can be land, it can be factory or something else. So generally, an asset-light business or working capital business is something an avoidable thing actually. If you look at credit, even if investors are thinking of directly investing in any instruments, they should keep this in mind. Equity wise, it works very well because people like asset light businesses, but in debt it doesn't work like that, because god forbid something goes wrong in any of these companies, you lose all your money actually. If you have some land, some factory, from that perspective you have something to recover actually. Then there are certain sectors actually, like from a credit it doesn't work actually. Trading, jewelry, media, microfinance is something we have put, some investors are comfortable, but that's a different thing. New age businesses, and even a EPC kind of a company. So again, you think the flavor is very asset light businesses actually, and intangibles built in actually. You don't know, the underlying asset collateral is not there, it is very intangible. There are new businesses where we don't have a history actually. So when you do credit, you want to see how the guy has behaved in a bad time, how has the individual behaved. So when you look at a equity story, you always want to see how has the promoter behaved with his shareholders in the past actually. So that's one of the reasons, as you rightly mentioned, some people don't invest in IPO. So like we also think we don't invest in new age company actually. Then credit, you need to see has he defaulted in the past, and how has he behaved. Has he given losses to the investors or stakeholders? So again, it's a kind of a red flag for us, and we don't want to touch those things. So these are typical no-dos in a performing credit fund. So what are the things you should look at actually? And if you see it, it exactly echo how a equity guy will think of it. You want to deal with a good promoter who has good track record of corporate governance. You want to have a company which has a vintage of operation, like 10, 15 years history. The company has been in business for a long period of time. You know how the company has tied over various ups and downs actually. Then the other most important thing in our business is how do you get these deals actually? Because that's the most critical thing. Investors will give me the capital. How do I originate these trades? So our focus is to do more direct origination. We do more bottom-up analysis and reach out to the companies for addressing their needs. Definitely there are arrangers and investment bankers who also help us out. But ideally we want to focus on direct origination, because you can originate with a direct relationship with the client and the economics can be far better. And more importantly, you take out the competition who is willing to come in there actually. And the most two important things at the bottom are cash flows and collateral. Cash flows are very important, how your money is going to come back. I think it is the most important thing in credit. What is your exit? How are you going to get your money back? And if something goes wrong, what is the collateral you have? So these last 2 points are super critical when you think of any of the credit proposals, whether you want to invest directly or you want to invest through a manager. How is somebody thinking about these aspects is very critical actually, because you can't believe that you are financing today and somebody will refinance you 5 years later, because we don't know how the market would be at that point of time. So you need to see what is the ability of that business to generate cash. Will it be able to generate sufficient cash to pay you out? And if something goes wrong, how valuable is the asset? What is your asset cover? Definitely, it is not the base case view that I will go and liquidate the asset. But if something goes wrong, we have to take those steps to recover my money actually. So that's the kind of a framework which typically a performing credit fund will work actually.
Sure. Subsequent, question, if I, put myself again in investor's shoes, again equating this to equity, is that when you invest in equity, to an extent, the market level, the valuations, the overall macro environment does matter.
Yeah.
There are certain there are certain timings, which are very favorable for equities and asset class. Now, in the context of performing private credit, what are the drivers? Like, for example, today interest rates are almost at their peak. we have seen, interest rates going up over last 2 years. Now, for the success of a private credit fund like yours, you need to find out good deals, and those good deals, where you can lend at maybe closer to 14% and also get good collateral. Now, such current environment, is it conducive for, or is it a conducive driving factor for your fund to be successful? And over, say, your tenure of the fund, it is expected interest rates now maybe eventually have peaked, they will come down. How will that impact the investors who will say, want to invest in such a product?
Okay, let me address the interest rate part earlier. So basically, this asset profile is more demand supply. So you can price your transaction based on what solution you are giving to the customer and how you can price it. Interest rate will do play some bit, but we don't expect the interest rate to deviate substantially. We end up doing some transaction which are floating rate. So if interest rate goes up, we also do get benefit. If interest rate goes down, the client gets benefit actually. But our belief is that in this business is pretty much a fixed interest rate that we are comfortable with, where effectively we'll tell investors like this is what we have contracted and this the borrower is going to give us actually. But in a rising interest rate scenario, definitely it can be a strain on the company. At that point of time, his cost of capital will go up. So you need to again evaluate from a credit metrics perspective. How is the company's cash flow? What kind of debt to EBITDA we have? What is the debt to equity the company has? And what kind of collateral you have? And what is the effectively a simple debt metrics which you will typically calculate? How are they stacking up? So there are certain parameters which every investor will look for. You can't lend to a company which is very well leveraged and there is no cash flow underlying to pay that loan actually. So you need to identify the companies when you evaluate from a credit perspective, like if this is the interest rate, this is the repayment schedule, how is the company's cash flows are stacking up to address the repayment schedule. You don't want your company to be in default. So you will ensure that based on a set of projections which you have done based on your diligence, is the cash flow sufficient enough to pay you? So you will put a debt amount which is equal to the cash flow which can be sustained by the company actually. You don't want to do that. But again, you also need to check these companies, how they are performing. So you need to put certain covenants on them that they cannot borrow, or if they have to borrow, they can borrow within this limit. They can't do any acquisition or they can't do any new business venture without the prior permission. Because any of these activities will hurt or change my view on the company. Like as an equity investor, the way you can restrict a company to do an M&A, or you can restrict the company to do a capex or a related party transaction, in a lender or a credit side, you have much more stronger controls and balances, which are very important to have actually. So because then you can control the company, what are the things they can do and they cannot do. If they are not doing as per what you have stipulated, it would be a breach of covenant, which no borrower will like to have actually. So that's the way you think of it. Now coming on the opportunity side actually, because that is the most critical thing, because there is a lot of funds who are being in the market right now and every investor is looking at various credit funds. Just to going back on an old point, again, credit fund you have to put in different buckets, and what is a performing, what is distress, and what is venture, and then you have to think what is a credit fund. So in a performing credit space, if you look at it, the market is in a very nascent stage in India actually. The traditional capital providers have gone back. They are not going to come back very soon. Neither they will come back even because of the way the regulatory regime has changed. Globally, if you look at it, funds are the best way to provide this kind of capital actually. So in India, like what is happening, there are a lot of global funds who have come in, but they are targeting the special situation and high spectrum of the transactions. The people who are focusing on this aspect are typically the foreign banks, few NBFCs, and most of the domestic funds actually. But unfortunately, the market of the fund is so small that cumulatively, my estimate is that dry powder, all the funds put together in the performing credit space will not be more than $1 billion as we speak right now. The market opportunity is much larger actually. Because one of the points which we say on this is that in last 12 months, as ICICI Prudential, we would have seen more than like 200 transactions to invest, of which we have picked 13. So the flow is very well actually. You need to pick and choose what you want to do and you don't want to do. It's not that all 200 transactions I will like to do, because a lot of transaction will not fit our investment parameter. But the good thing is that we are seeing a lot more flow actually, which helps us to make a very good decision and picking and choosing the right set of the companies to do it actually. So we are not worried that there are a lot more competition, because the demand is far higher of this kind of capital. Because to think of it today, at least 100 companies have received a SEBI card for an IPO. I don't believe that all these 100 companies will go for an IPO. At best 20 or 30. Even let's assume 50 companies will go by IPO. 50 companies are still there who will not see the light of IPO. These companies will need capital, either for taking out their shareholders or either for doing the capex. Who will provide this capital? So I'm not very nervous like this money. We have a lot more funds and we don't have deals. Deals are there. I think you need to pick and choose your slots rightly in what kind of transaction you want to do and you don't want to do. And transactions are there, and the industry is in very early stage as we speak. So the pool of money in this, whether it's performing, distress, special situation, is going to go up as we move forward in future.
Sure, Shekhar. So, many investors, ultra HNIs who have in the past done investments in category 2 private equity funds, or I would say something like pre-IPO funds or private debt funds, where there is a drawdown structure and they have to fulfill that drawdown, over a period of time. They have seen that what happens at sometimes the fund has raised so much commitment that it is unable to actually raise that commitment in terms of drawdowns as per the schedule. It has happened in the case of pre-IPO funds. As IPO market dried, they could not get so many deals,
Yeah.
and it has kind of delayed the process of investment. And at the same time, equity market is running, right? So that kind of creates, I would say, doubt in the minds of investors in investing in such a drawdown oriented structure.
Yeah.
And at times, investors blame that the fund has actually turned greedy by maybe accessing the green shoe option and maybe raising more commitments than there were number of deals. Now, in this regards, how is it that you want to address about your vision as a fund manager and head of private credit at ICICI AMC for investors who will have such doubt while they would want to consider investing in a product like yours, coming from ICICI AMC and coming into performing private credit, which is actually, I would say, a space where there are rare funds, and hence there is definitely an attractive opportunity. But yes, this doubt needs to be addressed.
Sure. So I think you raise a very right point actually, because in the fund structure, we call capital as and when the transactions are ready to fund. We don't take capital upfront. If assuming you are committing 100 rupees to us, we will take a small amount on signing, and the balance would be drawn over next 12 to 18 months. Effectively, there is a commitment period during which we can call the money, which is normally 3 years. But in our first fund, which we raised last year, which we are nearly completing the deployment, we took about 15 months to deploy that capital. So as I told you, today as we speak, we are not seeing a market where credit is flooding. So much liquidity is there that credit is chasing actually. We have ample choices to say no to a lot more deals actually. So I'm not nervous like we won't be able to deploy it. Definitely if you raise $2 billion of capital, yes, you may have some view, because at a 2,000 crore capital or 3,000 crore capital, you can do transactions of 100 crores, 200 crore or 300 crore. The reason like a lot of global funds are not able to do this because their fund size is 25 billion, 10 billion. At that size, you will not be able to do a 10, $15 million transactions. So luckily for domestic funds, we have the luxury that the capital which we all are raising right now as an industry is not very large that we will really struggle to deploy, at least in near to medium term. I don't see that scenario happening in next at least 3 to 5 years. Maybe 3 years, 4 years later, if actually the investors are so happy to give us money, we may have that challenge of delayed deployment, because that's what exactly happened in the pre-IPO, where market was so small and suddenly so much money came in that market with multiple players, then you don't have transactions. But again, there also, if you see, people who had access to the transactions were able to do it very well actually, and certain set of managers who were not having that access, because it's not that everybody don't have access to deals, but it is how you originate, how you think about the transaction is very important, and that's where the space of deployment would be there. But any investor who is committing capital to these kind of fund should be ready to have a drawdown structure in mind. We are not taking the entire money upfront. It will take 12 to 15 months. Definitely some funds may deploy it faster. In our pace, I am guiding the investor that you will take 12 to 15 months to deploy this money. But yes, deals are ample in nature. I don't foresee a scenario what has happened in the pre-IPO market for now, because we are very small as we speak. And just to bear in mind, credit market is much bigger as compared to a pre-IPO market, Kamal.
Yeah, well and well explained. Again, we have covered, I think, 90% of the questions that I had in my mind. But talking about risks now, so obviously, the target profile of investors who should ideally be considering, I would say, investing in such a product are ultra HNIs or family
Yeah.
offices, as you rightly mentioned. And
Right.
these investors certainly do not mind taking illiquidity risk because they always have ample amount of capital and regular flow of income coming to them. So, apart from illiquidity risk, how does the transaction actually happen? Is something that they would want to understand in terms of, if any eventuality happens, how does it, how is the worst scenario managed? So, where is it that collateral is kept? Is collateral kept with trustee? How does that collateral unwinding happen? And then how much collateral is taken? And if there is a kind of a possibility of that happening, right? So what to expect in that scenario, and has that happened in the past? So we want to understand in terms of the paperwork, in terms of the overall structuring when you do this deal. Obviously, it's not that investor wants to get into nitty gritties, but broadly, he wants to have that understanding of this context.
Okay. So let me start with a few things. As a AIF2, we are regulated by the SEBI as a regulator. Instruments which we can invest through in AIF is in form of non-convertible debentures. So these are debentures actually. Now this can be listed and unlisted both. It can be rated and unrated. We are flexible to do both actually. There is no compulsion to get this instrument rated or listed as per our requirements. Now all our transactions which we do are collateral backed. Now collateral can be in form of shares as share pledge. It can be in form of real estate. It can be in the form of factory, and it can be in form of personal guarantees. That's what the physical assets you have. Now, these assets or transaction documents are drafted by an external legal counsel for us, who draft typically a debenture agreement, a trustee agreement, a securities agreement. We have an independent legal team which reviews every document out here. Now, this security is kept with a trustee. So we don't keep the security ourselves. There are SEBI regulated trusteeship companies who we assign the security. They are signatory to a document. So effectively, they are so-called the managers of that particular asset if something goes wrong. And let's now take a scenario. God forbid something goes wrong. Our fund is very young, so thankfully nothing has happened. But I have seen distress in the past, and what can happen actually. Let me take it out. If you have a collateral of a asset, what will you do? First, you will initiate a kind of a requirement from the company. Please, you are in default, make the payment. If he makes the payment easy, life is easy. But if there is a challenge that he is not able to make the payment, and there can be two reasons. One is the industry is doing bad. He doesn't have cash. And second is that he has gone rogue. He is like a bad promoter who doesn't want to make the payment. So if the second event happens, it is very bad on my part or as a manager's part that we have chosen a wrong guy to lend money. But if that event has happened, let's see what can you do. Now, there are enough legal threats as we speak right now. I highlighted IBC, which is the bankruptcy code, which happened in 2016. People have a view that it is taking long time. It is not doing well. But think of the scenario like today we have seen promoters losing their companies in the bankruptcy courts. The promoters have lost their company and new promoters have come in actually. So definitely that's a very big legal threat in the mind of the borrower that if he misbehaves, he can lose his company. But we don't need to go that far actually. If you pick up the record of the IBC as a court, there is a reference and there is an admission. So if 100 cases are referred to the IBC court every year, approximately 50-60% of transactions cases are resolved even before admission. What does it mean? That borrower has come forward and settled the account actually with the issuer or the investor. Only the rest of the case goes to the admission of the IBC, which can be a long drawn and a painful process for all the stakeholders. But we should see the other side of the table that 50-60% of transactions are resolved or paid before the admission. So think of it that IBC is a big handle which as an investor we have, that we can engineer out here to get the guy behave well with us if something goes wrong actually. So I personally believe the legal construct and the structure in India has become much better over last few years and give enough rights and abilities to the investor that the borrower should behave well with you actually. And the same point of time, Kamal, one point should think of it that when you are looking at a company to invest, you also need to think where are you in his scheme of things. If you are a very small investor in his large company, he will not bother about you. But if you are reasonable size in his company, he will always behave well with you actually. So again, those dynamics also play well with here actually. And definitely with the ICICI Prudential AMC, I think the leverage we have or the ability and resources we can tap is far higher to influence the borrower to at least he should behave well with us actually.
Sure. So from investors' point of view, the last question that comes to my mind is how to evaluate, within performing credit, say there are a couple of options. Why ICICI Prudential AMC, and why not maybe, any other fund in this category?
I think it's not sales pitch actually, but you should look at three things investors should look at it, whether they're looking ICICI Prudential or any other product. You should look at the pedigree of the sponsor actually. Here we have ICICI Prudential. You should think how much money the sponsor is committing to the fund. Because are they also investing along with you or not actually? That's a big amount. Then the third thing is that what is the track record or the management team who is managing the fund actually? What have they done? Have they done a different kind of products or what have they in their track record? Then in terms of investment strategy, that is an individual preference. If somebody wants to do a special situation, he should evaluate the manager from that lens. If somebody is looking at performing credit, he should evaluate the manager from that perspective. But what is the investment strategy? Like I told, like my investment strategy, when we look at it, what are the do's and don'ts? You may have a different way of do's and don'ts in your mind actually. So you should think, what are you comfortable with? Whether these do's and don'ts fit you or you think there's something more to it or that doesn't work for you actually. So when as an investor, I look at it, I should look at who's the sponsor, what is the sponsor's stake in the entire business, and more importantly, how have they done in the past actually, and what is the investment strategy they are going to follow, and are you in favor of that investment strategy or not? Assuming you are a large cap investor and I tell you small cap, please invest in small cap, you will not like to go through that actually. So it is again an individual preference, what risk he want to take, with whom he want to take that risk, and what is the manager's kind of thought process behind taking that risk actually. So I think economics is also there, whether the fund has a fixed fee, it has a carry, because all these are kind of deductions from your return actually. Like we work on a fixed fee model, we don't charge performance fee or carry, but a different fund would have a different strategy actually. So an investor, that will also come in play. What is the kind of expense ratio in the fund actually?
So for a performing credit kind of a fund, I think fixed fee option is definitely more in the favor of investors, because here increasing returns is not that important.
Exactly.
But obviously, I would say taking care of the linearity in the returns is more important. And that brings me to maybe the last question. I did not want to ask this, but there are, investors who are asking this in the chat. So what is the kind of, expected distribution of income when we are talking about the gross returns of say around 12% net of expenses? Out of this return, how much will come on annual basis and how much will get maybe, delayed in form of redemption premiums?
Perfect. So I can speak about our fund. Actually, we have a first fund which is nearly deployed. We are distributing about nearly 60% of the 12% on a quarterly basis. So think of it, 6-7% comes on and on an IRR basis comes every quarter, and balance will come on redemption. But there are some funds who will give like 12% regular, but again, different profiles of risk, different products actually.
Absolutely. I think, we come to end, and while I give my concluding remarks, I feel that in the context of debt as an asset class, keeping in mind an ultra HNI investor, this fund has a logical meaning, because here we are trying to balance between risk and return, and there are various reasons which give comfort to the investor from the point of view of risks, given the background of the sponsor as you mentioned, and the category where you are investing, which is performing credit, and at the same time the fee structure that you talked about. All these factors are kind of conducive. The only thing is that yes, investors need to understand this asset class. They need to understand and set right expectations, and obviously, for that they can book appointment with us. We are most, welcoming any of the investors who feels that he wants to learn more about this particular product or this particular asset class. We at PMSAIF World have been doing these webinars throughout, since our inception, and introducing only those fund managers and those products which we are convinced about. And I never generally vouch about a product, but here I myself feel that yes, the origination of this product is meaningful, and that's where I am confidently saying that all the prospective clients, investors who want to learn more and who want to kind of understand and maybe want us to organize one-on-one appointment or a discussion with the fund management team, you're most welcome. Thank you, Shekhar, for taking our time today. I think all pertinent questions have been well answered. If any questions still remain unanswered, you can write to us. You can write to me. You can visit our website pmsaiworld.com. You will get all the contact details there. Thank you, everyone, for joining us today.
Thank you, Kamal. Thank you.